Welcome to Alpha Recap, your after-hours wrap of the market day. Markets closed on February 26, and it was a headline-driven session. Lots to unpack. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Big day. So, what really stands out here is the scale of a few very targeted stories pushing money around.
Right, the three biggest movers were a record government loan to Southern Company, a fresh round of flows into US spot Bitcoin exchange-traded funds, and a blockbuster energy deal in Europe. Those pushed capital toward utilities and the energy transition, while pressuring some higher-risk, policy-sensitive corners of the market.
Hold on. Can you give the numbers on those? I want the scale.
Sure. The Department of Energy approved a loan package of about $26.5 billion for Southern Company. And reported inflows into US spot Bitcoin ETFs totaled roughly $506 million, which helped Bitcoin run back towards $70,000. And Engie announced the deal in the UK for about $14 billion.
Wow. That DOE loan, frankly, changed the tone for utilities, right?
Exactly. The loan materially reduces financing and execution risk for large-scale grid and clean energy projects. For investors, that meant regulated utilities with big project pipelines looked a lot more attractive. When the government steps in like that, it lowers the hurdle to get these projects built and lets rate-based growth look more certain.
Right. And the other thing is that it isn't just Southern Company that benefits. It lifts solar contractors, transmission players, and anyone tied into grid modernization.
Correct. You saw strength across utilities and renewable-linked energy names. Companies with execution capabilities and regulated franchises outperformed. Meanwhile, Engie's big UK acquisition reinforced consolidation as a theme. Scale matters for deploying renewables and integrating offshore and onshore assets.
And crypto made headlines too. The ETF flows feel like a renewed institutional on-ramp.
They do. Spot ETF inflows, that roughly $506 million, showed how a tradable ETF wrapper amplifies institutional capital. It pushed Bitcoin back towards $70,000 and helped lift some altcoins as well. But regulatory scrutiny around stablecoin yield mechanics is still lingering in the background, so risk remains.
I mean, when you step back and look at this, ETFs are a cleaner way for many investors to get crypto exposure versus direct custody. Simpler compliance and clearer custody chains.
Exactly. That's the tactical takeaway for some investors. Regulated products can be a lower friction entry point, but you still need to size for policy risk around stablecoins and tokenized yields.
Let's talk materials. There were a lot of drill results today, but also a geopolitical hiccup.
Right, juniors focused on lithium, copper, and rare earths released strong assays and resource upgrades. That supports battery supply chain economics. But a Zimbabwe export freeze highlighted jurisdictional execution risk. So the rally was selective. Advanced, permitted projects outperformed early-stage explorers operating in risky jurisdictions.
Yeah, that tracks.
On the downside, we saw pressure in cannabis and parts of real estate. State-level policy patchworks and slowing price momentum in some property segments weighed on stocks.
Honestly, I was a bit surprised by how much policy headlines moved cannabis names. It was a messy state-by-state story, not a tidy national trend.
Short and sharp reactions. Retail-heavy cannabis names without diversified revenue got punished. Real estate saw spotty strength in industrial and logistics, but warnings about mortgage trust exposures and rising delinquencies created more caution.
Quick pause. 2 tiny reactions.
Right. Let's step back and pull the cross-sector themes together. First, the energy transition is now pulling capital from multiple places. Government loans, M&A, private capital. And that showed up across utilities, energy, and materials.
Second, policy and regulation are still a dominant risk vector. We saw that with stablecoin yield scrutiny, the CMS moratorium on new equipment suppliers, and the CFPB case backdrop. Those regulatory moves can reprice whole subsectors quickly.
Third, there's an AI and infrastructure dichotomy. AI demand is boosting spending on GPUs, networking, and cloud capacity. That's supported infrastructure and software names. At the same time, memory price weakness and an analyst downgrade created headwinds for commodity suppliers in the stack.
So, what really stands out here is that capital is being very selective. Favor the companies capturing AI spend and the firms executing energy projects, not the cyclical commodity suppliers or early-stage miners in risky countries.
Exactly. Liquidity and safe haven flows mattered too. Treasury yields slid amid the rotation, which helped long-duration, regulated assets and tightened spreads for some issuers. That dynamic supported utilities today.
Okay, practical investing takeaways. What would you position for the next 1 to 3 months?
Near-term, overweight regulated utilities with clear project pipelines and transmission exposure. Favour energy names with integrated renewables and M&A optionality. Be selective in materials. Prefer near-term permitted projects or juniors with low jurisdictional risk. For crypto, consider exposure via regulated spot ETFs rather than direct custody for many institutions. In tech, overweight AI infrastructure, cloud partners and software, and underweight commodity memory cyclicals.
Right. And the other thing is, in real estate, favor industrial and mixed use with strong tenant covenants, but be cautious on high-leverage residential names tied to consumer credit stress.
Good call. And in healthcare, play M&A beneficiaries but hedge regulatory risk. Deals like the recent purchase of CarePath RX show vertical integration is in play. But the CMS moratorium can create near-term revenue uncertainty for suppliers.
So, what really stands out here is the need for active risk management. Any specific tactical trade ideas?
A few. Long regulated utilities versus short, high-cost merchant generators that lack transition strategies. Long spot Bitcoin via ETFs with a modest hedge for regulatory risk. Long AI infrastructure plays and trim memory exposures. And avoid big allocations to early-stage miners without permits or safe jurisdictions.
And risk management triggers?
Watch for regulatory inflection points, CFPB and CMS rulings, stablecoin guidance out of Washington, any Zimbabwe export updates, and EU crypto licensing moves. Also monitor Treasury yields and credit spreads closely, because a move there could reshuffle leadership quickly. For materials and miners, upcoming assay results and permitting milestones will be binary events.
2 quick micro points. 1. Earnings from big memory makers and the usual tech names will test whether AI spend can offset memory weakness. 2. Keep an eye on the implementation timeline for the Southern Company loan. Permitting and contract awards are the next milestones.
Exactly. Those timelines are where the headline becomes investable reality. If project contracts and permits follow the loan, the financing risk falls dramatically.
Small note. I love that investors are suddenly very excited about transmission lines. Big move.
Big move indeed. Final takeaways. February 26's tape showed coordinated rotation rather than broad risk-on. Government capital, ETF flows, and regulatory headlines steered money toward defensible, execution-oriented names, utilities, integrated renewable players, and AI infrastructure, while policy-sensitive areas like cannabis and certain parts of real estate were under pressure.
I mean, when you step back and look at this, the smart play is selectivity. Favor clear cash flow visibility, permitted projects, and secular exposures like electrification and AI. Size positions thoughtfully and keep an eye on the regulatory calendar.
So what really stands out here is that regulation will keep setting the rhythm. Stablecoin rules, CMS decisions, state cannabis votes. Those are catalysts you have to monitor.
Final tiny reactions.
Right.
Yeah, that tracks.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's it from us. Catch you next time on Alpha Recap.